If you operate a private company in Victoria, there is a very good chance that at some point money has moved between your company and you personally, or between your company and another related entity. Today, I want to explain what Division 7A is, why it matters, and what the bookkeeping and balance sheet implications are for business owners. Division 7A is a provision in the Income Tax Assessment Act 1936. Its purpose is straightforward: to prevent private company profits from being distributed to shareholders in the form of loans that are never genuinely repaid, thereby avoiding the tax that would apply if the money were paid out as a dividend or salary. Here is how the trap works. Your company has retained profits, you need some cash personally. Instead of paying yourself a salary or declaring a dividend, you take a loan from the company. If that loan is not on a complying written agreement with the correct interest rate and minimum repayment schedule, the ATO treats the entire loan as an unfranked dividend in the year it was made. Unfranked dividend means no franking credits, so the full amount is included in your assessable income. For a loan of $100,000, that can easily translate to $35,000 or more in additional tax. To make the loan compliant, you need 4 things: a written agreement signed before the company's income tax return is due, an interest rate at or above the ATO's benchmark rate, a maximum term of 7 years for an unsecured loan or 25 years if secured by a registered mortgage, and a minimum annual repayment made every year the loan is outstanding. If a minimum annual repayment is missed even once, the shortfall in that year is treated as an unfranked dividend, so the documentation is not a one-time task. You need to track the loan balance, calculate the correct minimum repayment each year, and make sure it is actually paid before the end of the income year. On the balance sheet in Xero, the loan from the company to a director or related entity sits as a related party receivable, which is an asset. In the borrowing entity, the same loan appears as a related party payable, which is a liability. Current or non-current classification depends on when repayment is due. If the loan is due within 12 months, it is current. If it extends beyond 12 months, the portion due in more than a year is non-current. Intercompany loans between 2 related companies work the same way. The lending company records a related party receivable. The borrowing company records a related party payable. Both need to be reconciled to each other regularly so that the balance in both systems agrees before interest and minimum repayment calculations are made. If your company structure includes a trust with a corporate beneficiary and distributions are not paid out to beneficiaries by the 30th of June, you may have created what is called an unpaid present entitlement arrangement that itself engages Division 7A. This is a common situation in family trust structures and requires your accountant and bookkeeper to work closely together. The most common bookkeeping errors I see are classifying a director's drawings as salary expenses without a payroll event, no written loan agreement executed before the company's tax return due date, missing minimum annual repayments that then become deemed dividends in that year, intercompany loan accounts in 2 different Xero files that do not reconcile with each other, and no separation of principal and interest in each payment. If you are unsure whether your intercompany loan accounts are correctly set up and Division 7A compliant, book a free call with TrueTally Bookkeeping at truetally.com.au or call us on 04681599550. We work across Victoria and help businesses get their related party loan accounts right in Xero so your accountant has clean records to work from.